All right, welcome to Talk Tickers. Today, we're diving deep into Concentra's third quarter earnings for 2025. And this is a really interesting one. It's the classic story of a company that seems to be firing on all cylinders, but for some reason, the market is just giving it the cold shoulder. So let's get into it.
I mean, on the surface, this quarter looks like a total home run. The company blew past expectations and even raised its outlook for the rest of the year. So the big question we've got to ask is, what's going on here? Why is there this huge disconnect between these fantastic results and how the stock is actually performing?
Let's start with the headline numbers, because they're pretty impressive. Concentra delivered adjusted earnings per share of 39 cents. Now, Wall Street was only looking for 37 cents, so that's a really solid 5.4% beat right there.
And hey, the top line, just as strong. Revenue for the third quarter came in at $572.8 million. That just cruised past what the analysts were expecting, which was somewhere around $565 million.
And this wasn't just some tiny beat, you know? That revenue number is a powerful 17% higher than it was this time last year. Let's be real. In today's uncertain economy, seeing that kind of double-digit growth is exactly what you hope for. It's a huge number.
So, how'd they pull this off? Let's peel back the layers and look underneath those headline numbers to see what was really powering this quarter.
The cool thing is, this growth wasn't just coming from one little corner of the business. Management made it clear that their strength was broad-based. It came down to three key things. They had more people coming through the door, so solid volume increases. They had strong pricing power, and they're doing a great job bringing their recent acquisitions, like Nova Medical Centers, into the fold.
Okay, now this is where it gets really interesting when you break it down. Their main business, Occupational Health, grew a very healthy 13.6%. But just look at the on-site health clinics. I mean, wow, up an incredible 123.8%. That was almost all fueled by their buyout of Pivot On-Site Innovations, which just goes to show their M&A strategy is having a massive impact on the top line. And even their original on-site business grew over 17%.
And speaking of that M&A strategy, management basically said the heavy lifting is done. They've already captured about 85% of the synergies they planned for from that big Nova deal, and Pivot is pretty much integrated. So now they're shifting their focus back to their bread and butter, smaller, tuck-in acquisitions of just 1 to 5 centers, which historically they've been able to buy at really attractive prices.
And you could really hear the confidence from management on the call. The CEO, Keith Newton, was pointing to that solid volume and rate growth, making it super clear that they see real fundamental strength in the business, even while they admit things are a bit uncertain out there in the broader economy.
And look, it wasn't just talk. They put their money where their mouth is by raising the low end of their full-year guidance for both revenue and adjusted EBITDA. That's a huge signal that they expect this momentum to keep right on rolling.
Okay, so the company is crushing it, right? Which brings us back to the market's strange reaction. And this is where we really get into that disconnect, the bull story versus the bear story.
This chart, wow, it really says it all, doesn't it? Over the last year, Concentra's stock is actually down more than 7%. At the same time, the broader healthcare sector is up over 8%. That is some serious underperformance, and it's exactly what's got shareholders so frustrated.
Which, of course, leads us right to the heart of the bear argument. If the actual operations are this strong, what in the world are the headwinds that have investors either selling the stock or just staying away completely?
Well, it really comes down to a few key issues. Investors are a little nervous about the company's debt, which is sitting around 3.6 times. They're also worried about how higher interest rates are going to affect that debt. But the really big one, the one people are pointing to, is the recent pressure on their free cash flow.
So, let's take a quick step back. What even is free cash flow? Well, to put it simply, it's the actual cash a company has left over after it pays for all its day-to-day operations and invests in its buildings and equipment. It's a super critical way to measure a company's financial health, because that's the money they use to pay down debt, give back to shareholders, or reinvest for growth. So yeah, when that number goes down, investors definitely notice.
And yeah, Concentra's free cash flow absolutely took a hit this quarter. It fell about 21% from last year, down to $40.2 million. So why the big drop? Well, there are two main culprits here. First, their cash interest payments shot up by $25 million because of higher rates and the debt they took on. And second, they had some one-time capital expenses tied to getting that big Nova acquisition all sorted out.
So you see the tug-of-war we've got here, right? We've got incredibly strong operational growth on one side, but some very real concerns about the balance sheet and cash flow on the other. So let's pull all this together and give you our forward-looking take. Looking ahead, here are the key things we're going to be watching for. First, can they keep up this momentum on volume and pricing as we head into 2026? Second, are they going to hit their targets for paying down debt? We'll also be keeping an eye on how many of those new tuck-in deals they do. And this one's crucial. We need to see proof that their investments in tech are finally starting to boost their margins and cash flow. All right, here's our call. For the fourth quarter, we fully expect Concentra to meet its raised guidance. That operational strength is just too solid. But, and this is a big but, we predict the stock is probably going to stay stuck in a rut for a little while. The market needs to see more than just one good quarter of paying down debt and a really clear turning point in free cash flow before it's going to be willing to give the stock a higher valuation in 2026.
But even with all of that said, our rating here is outperform. The general consensus on Wall Street is a buy, with price targets suggesting something like 40 to 45% upside from here, and honestly, we agree with that sentiment. The operational engine of this company is just performing exceptionally well, and they're generating plenty of cash to handle their debt and keep investing in growth. We believe that as those one-time integration costs fade away and the debt reduction becomes more obvious, the market is going to have to wake up and reward the incredible fundamental strength of this business.
So, that's our take on Concentra's Q3. And of course, this is not financial advice.